Welcome to Money Discourse. Well, we made it. There was no nuclear explosion and we're successfully into 2023. So today we need to discuss our highlights of 2022 and our predictions for 2023. Rajan, why don't you take it away?
Yeah, well, 2022, I think most investors can say that this was one of the most difficult years. I think it was a rude awakening for a lot of people, including myself, that been lured into this sense of low rate, easy monetary policy for the last however many years, and all we've been used to is an up market. And this is the way the market acts. It's like when you think you've got it covered, it just smacks you back down. And what really killed us really was the way 2020, 2021 played out. It makes you lose sight of real value. You just see things going in the air, just through the roof. All of a sudden, 50%, 100% gains in such a short amount of time just wasn't good enough because you're hodling for the 300%, the 400%. Like I remember before, you get a 10% return on a stock in a year, 15%, you'll take it or you'll be happy. And now, we got so used to having quick 50% gains, 100% gains. And it really changed the mindset that when we sort of went back to what I would call a more normal market, it left a lot of people unprepared and it just basically cleaned out a lot of people. There's been a lot of people that have been hurt. But at the same time, I think it was necessary because the way the market's been acting for such a long time that this was inevitable. And we always were saying it was inevitable. We always said this was going to happen. The question is when it was going to happen and the severity of which it happens. And I think there's been although the market as an index has not actually been too bad, but on an individual stock basis, there's been some real demolitions. I mean, especially some of these high beta names, SPACs. In fact, that was the first podcast we talked about. We talked about SPACs, and I look at a handful of SPACs, and the amount under $1, under 50 cents, is incredible. There was this one SPAC that I just saw this week. I forgot what it was called, but it was getting taken out for 30 cents. I mean, this is a takeover bid coming at 30 cents. I have to look at what which one it was, but I mean, Semaphore. I remember that one. It's a genetic play. I remember Cathie Wood bought it at $22 as soon as when the SPAC went live, announcing the merger with Semaphore. It's now a 24-cent stock, and the wealth destruction, especially in the SPACs, these high growth names, like I was saying, like Chamath said in that all-in pod, that high beta tech names was the worst thing you could be long this year. And inevitably, I could imagine most retail customers were long them stocks. So it's been a very, very painful year. And even though the market's only down, when I say only down 20%, realistically, the bludgeoning behind that has been on another level. But now coming into 2023, I mean, first of all, for those stocks, I mean, you sort of think like, where can they really go now? They're like 50 cents. They're down 70% from the high, 70 to 99% off the high. Some of those I still think are pretty good value. And I think what's happened with a lot of these stocks is there's been so much stock-based compensation and so much stock has been coming onto the market from a lot of these people that work there, and they're just dumping it as soon as it goes live, and that's really been depressing the price. And so I think it'll be interesting now, 2023. I don't think we're going to have the same, because if you look at it, when we started 2022, where was the rates? It was still zero pretty much, and now we're at 4.5% for the US. UK is up there, Canada. So realistically, we've seen, and what we mentioned last time, we saw some of these prices. We've seen gas now over here at least well below $3 in New Jersey, and it's coming down everywhere. And I think inflation is going to sort of trough out. So I just can't see the Fed having that same path as it has so far this year, and which has probably been the fastest rate hike cycle, I think, in decades. So it's going to be a different year, especially. So I think this is really going to it's going to be a stock pickers market. You can try to look at what is, if you can see cash flow is king in this market, and those type of companies that are generating profits and do have a good cash flow, I think will be the winners this year. So, I mean, that's my forecast for what I think will be the way this year works out. But I mean, what do you see on your end?
Going back to 2022, it just brings me back to one of these YouTubers I used to follow who was absolutely killing it. His name was Dead Inside, and now you can see what his portfolio is like this year. The market has extracted so much out of the retail investor this year, and it's the people who are sitting and who have kind of orchestrated this whole thing, which is all the big money, to be honest. They've absolutely cleaned up. November 20 2021 was the high, the peak euphoria. I remember Rajan and I were having a conversation with another friend of ours regarding crypto and all the airdrops and everything that was going on in that market. And that's another kind of massive highlight of 2021, which is literally just gone to flames now. 2022, like massive trust has been lost in crypto as well as pretty much the broader market. Like you were saying, these high beta tech stocks have just taken a massive hit, along with high profile massive scams like FTX really just shaking the massive amounts out of the coffers of the retail investor, like I was saying before. But also just the trust. I'm just thinking what needs to happen to bring that trust back, because if we go back to the COVID relief schemes and everything that was going on and putting a lot of money into the retail investors' pocket back then, is that going to be happening in the near future? I just don't think so. It's like, how do you entice a huge amount of retail money back in? Probably not. So it's actually all going to be determined by the big funds now. Like, they're going to be able to push the market whichever ways they want, really. And if that's the case, what gives them confidence to be putting money back in? And with rates so high now and forecasted to go even higher, and how long they stay high, really, next year, is it going to be that housing gets hit massively, and in that case, will some of those investors try to take relief in the stock market, or is it just going to be like, let's just stay in cash? Yeah,
it's crazy because when I was talking this earlier, I didn't even think about crypto and the amount of. I mean, we had Luna, which is a $50 billion market cap coin, and their stable coin USTC, which just collapsed, which was the unwinding of so many of these massive. It led to Free Arrows Capital going down pan, BlockFi. There's so many exchanges, Voyager, that got all caught up in this Luna, because so many of them, to give the yields that they were giving these clients, that so many YouTubers, may I say, were promoting. I guess it's not their fault, but open up a BlockFi account and get 8% interest, or an FTX account, get an 8% interest. But a lot of them were getting the funds and then putting it into Luna, the Terra, the stable coin from Luna, I've got USTC. And so when that went, so much of this perceived 20% yield on your stable coin, it just ruffled the feathers. And then inevitably that did lead to FTX going down as well, because Luna was a catalyst that has individually, as we've seen down the road with Free Arrows Capital, Voyager, FTX, and so many more. And then we just don't know still how far the contagion has gone. But you look at a lot of these things. We keep on seeing these random tweets that 66% of people who bought houses in 2021 are in negative equity. That's in the US. The amount of people that bought cars, especially used cars, in the past year are in negative equity. And in fact, that is basically, in my opinion, the next big shoe to drop. The amount of these loans, especially subprime loans for these cars. I mean, I don't know how many of you have heard on the radio and it goes, you got bad credit, don't matter. At Northeast Kia, we'll get you approved no matter what. You'll be leaving with a car. And it's the same subprime type of loans that they were giving out in the housing bubble. Was the same way with these cars. And at the same time, these guys are all paying these massive amounts, and they're all in negative equity. And so these guys can't really even refinance, because a lot of these banks won't refinance the value on a car when the car is worth less. You can probably refinance at the amount that the car is worth. So then you've got this gap that is there. So if you bought a car for, let's say, 40,000, is now deemed to be worth 30,000, and you want to refinance a 40,000 loan, you've got to make up that 10,000 to refinance that 30,000. So what's happened is that a lot of these guys with these subprime loans can't even refinance their loans unless they can come up with 5,000 to 10,000 to make up the gap between them. So you're going to have a lot of these people with high interest car loans, and inevitably they're going to default, and it probably makes sense for them to default, and you're going to have a lot of these repossessions of these cars, and that's going to bring down a lot of these used car prices. And so I think used car prices, definitely used cars in general, is going to be a really interesting point about how it's going to play out in 2022. And but I mean, if we look at 2021, let me just bring up the chart of what. Oops, yeah. So we look at the best performers, and what would you think that the best performer it was in 2022? In fact, it was actually orange juice, up 46%, 46% orange juice, heating oil, rough rice, natural gas. Natural gas up 18%, but at one point it was up multiples of that. So we've come off massively, especially with this warmer period of weather that we're getting right now. And then you've got soybeans, the VIX, and then you've got a lot of these, like the dollar was up 8%, crude down up 10%, but again, it's down massively from the high. At one point, it was up like 100%. And then if you look at the things that have been down, the worst performer was lumber, which was one of the biggest, especially in 2021. And with these new house builds, lumber prices were through the roof, and now it's down 66% year on year. Oats, the NASDAQ 100 down 33%. Well, there you go. That's what we're talking about, these tech names killing us. Ethanol, coffee. I don't see it. Starbucks is still, $7 a coffee now, even though coffee price is down 33%. See what I mean? So this is where this embedded inflation takes place. The Russell, the 30-year bond, the DAX, and mostly the worst performance were, some of these emerging currencies like the Canadian dollar, like these commodity currencies, the New Zealand dollar, the Australian dollar, as well as all of these index names. And we have a lot of these commodities which were the outperformers, but again, they're massively lower from where they were at the high. And then if we now look at the S&P 500, and in fact, since June, we've actually been range bound. So although it's still, I feel like in December, obviously a lot of it's to do with Tesla and that massive decline that we've had in Tesla that just really made it feel like the market has been horrible in the last month. But in fact, if you actually just look at the overall index of the S&P 500, it's actually been pretty range bound. And we had this move from the beginning of the year. And in fact, the high actually was the first day of last year, which was the 3rd of January, was the year high for the index. And then we had this move down, which was really, really difficult until the mid-year. And then since then, we have ranged. But again, it's a lot of the pain has come from some of the individual stocks, which has really, really been difficult. So, looking forward, I mean, for now, I could just see us ranging within this band still. But I mean, if we do take out, especially if we take out the year lows, which were, I think, about 3,500, then that might not be pretty. But I genuinely don't think we're going to have as many negative catalysts to really push it there, considering where some of these stocks have already been. And, that's just where I think. But again, anything can happen. But I don't really see us going, we might test it, but I don't see us sustaining below that 3,500 like the low of last year, just considering that we're tapering off in rates and we really are seeing a lot of these commodities come off quite a bit. So, this is what I see for, But I mean, now looking forward, the real thing is the way we've traded this year. Like, I mean, it's obviously been a learning year for you. I mean, strategies that worked so well in 2021 that just blew up in 2022, or it's a time for reflection. Let's say. I mean,
yeah, it's been pretty brutal. I mean, obviously, you know that I'm a diehard Tesla investor. It's been really, really tough 3-4 months with everything that's been going on with Elon, Twitter, and Tesla. It seems like us Tesla investors have been kind of very, very tested. You see in the Tesla Twitter community, there's been a lot of infighting between, it's been absolutely crazy. Looking at the chart from November last year to the end, it's just been a absolutely meteoric drop. People talking about Tesla going into the sub 100s, which it could do if we actually look at what Elon has actually been saying. Well, first of all, there's so many people on Twitter like this, sold my car and went all in on Tesla at 414, now down 65% on my investment. That's why I call it a skill. I guess, relate to that. But one of the main things is looking at what Elon is saying. Now, he tweeted, long-term fundamentals are extremely strong. Yeah, I think most people probably could agree with that. But the short-term market madness is unpredictable. And he's been tweeting and saying, even in his Twitter spaces that he's been on, and also in the All In podcast that he's been on, talking about it, he's saying, stay out of margin. And, he's saying, please take both of these sentences fully to heart. Now, if we look at Tesla right now, and we look at what the delivery estimates are going to be from analyst consensus, are saying about like 418 almost, which has come down from about 430,000 deliveries. Detroit Tesla, he's saying about 423. But I'm just thinking, if you want to be the contrarian, what is something that can hit you out from left field and looking at how Elon's talking, maybe he's just being very defensive, but he's had so many statements kind of negatively talking about the short term. What happens if they don't even hit 100,000 deliveries? Say if they come in like 395 or 399, or even just say 400 on the dot, you're going to see like a 20% drop on Tesla in just a day. It probably will recover after that pretty swiftly, but that would just be nuts. I'm not discounting the fact that that could happen. I'm not saying it's a very high likelihood. It's probably going to be around the 420 mark in terms of deliveries, but you just have to be prepared for it, because what Elon is saying, and it just makes me think twice.
The nuggets, he's planting little nuggets.
And just listen to what he's saying. I'm just saying, why is he so much about the short-term madness is unpredictable? He's trying to prepare us investors for something. Now, it might not be the deliveries. It might be something else. It might be the EPS might be way lower. It might be that their margins have been squeezed like crazy. It could be some product announcement that doesn't happen, or they might have to cancel the Roadster, or something else that's not related to deliveries. But when he's making such a big deal out of it and saying take it fully to heart, why is he warning it? He's never done that so much before. Why does he keep on saying that? Anyway, another thing that is going to hit Tesla is how, well, I guess the Biden administration hates Elon. They keep on doing
probably hate him more now. That's the thing.
And so what's happening is that a lot of Tesla models aren't actually eligible for the 7,500 tax credit, and that's a big shame. Because of the way that they've classified the vehicles. So they've classified the Model Y as a sedan, but they classify a Ford Escape hybrid as an SUV. Now, why this is crazy is that the Model Y has much more cargo space and is a bigger vehicle than the Ford Escape, right, as one. And the Model Y is a hybrid vehicle, but because they've classified that as an SUV, that has an $80,000 limit, or how much the Ford Escape can actually have an MSRP for. And what that means is that the Ford Escape is going to get the full 7,500, whilst the Model Y long range doesn't get it, which is just crazy. And if you're looking at some of these tweets out there, it's just crazy how all of these Ford cars will be eligible. But actually, what's crazy is the Ford Mustang Mach-E has a 55K limit, whilst the Ford Escape Hybrid, which is smaller than the Mustang, gets an 80K limit. It's just crazy. Like, what is happening? I don't understand.
The worst thing is the Mach-E, they've raised the prices on all of them. I don't think there'll be hardly any under 55K now.
Yeah,
and the craziest base model.
And now, if you look at the vehicles that are actually eligible, it's actually turning into a kind of anti-clean vehicle rebate, because it seems like a lot of these hybrids are getting sweeping up a lot of the credit. And if you think about these hybrids, the vehicle battery packs that they actually have in there are like, they cost between, like, say, 1,000. Maybe say between 500 and like 1,500 in terms of the battery pack. They're small battery packs that get you like maybe maximum 30 miles range, normally around 20 miles range in real world usage. And they're getting all the credits for 7,500. So, like, if you're a US citizen, your taxpayer dollars are putting money into the coffers of the manufacturers that make these hybrids, rather than the full EVs that should be the ones that you want to get the price down on. I just find it really distasteful for the way that they're actually doing it. I'm sure by March they will bring down the costs in line and try to like have it sorted out. But it seems like the way it starts out, anyone who actually bought a Tesla with the full 7,500 credit in the last couple of weeks of December and 22 probably walking out with the best deal for at least a little while, because it seems like they've classified the Model Y as a sedan, but the Model Y with 7 seats, which is exactly the same shape. Everything is the same cargo space, everything, but it's just got those 2 seats in the back extra. That can have an 80K limit, whilst the Model Y long range can't go for it, it's just so silly.
First of all, I just don't understand how hybrids in general now can get any tax credit. Because I remember when I was in the UK, you would get very favorable road tax for hybrids, but now I believe that it's gone, and you have to have a clear, pure EV to have like zero road tax, or whatever the figure is now. So I assume the same would happen over here, because a hybrid is still mainly petrol, and so it's not really that much of a clean vehicle, especially compared to a 100% EV. So I don't even understand how hybrids are even on there. But again, it's gonna help out Ford, it's gonna help out GM, and things like I don't know about Toyota and that. They probably have plants. I don't know if they're eligible because they're the king of hybrids. Yeah, I mean, I actually like their new Prius. It's finally they come out with a good Prius, a good looking Prius, and yeah. So I actually think that is good, and I wonder if that is even eligible. And if it is, then you can get a good deal on a Prius. That might be worth it because Prius is like 30 grand. If you can get 7.5K off a Prius, that's like 25% of the price. If that is true, that is something to look out for, 100%. If that is what the criteria is, but it's mad. But it'll be interesting. I think there will be a lot of jostling of those as it comes to realization, because I think hybrids are really still like one of the number one category of cars that get bought, and so it's going to really chew up on the limits that they have for the 7,500 really, really quickly. So I'll be intrigued if they maintain that for the beginning, but
that's where these legacy automakers, that's where they make a lot of their profits. So they want to keep things at the status quo as much as possible, and it seems like they've got into the ears of these regulators, or the people who are running the scheme anyway. Oh well, what can you say? But yeah, it's gonna hit Tesla, I'm sure. Why I think that is because Tesla are gonna have to keep their discounts high. Because I don't see, I think that people will just put it off till March if it's going to be that long until you can qualify for it. So that's going to hit margins as well.
Yeah, but I mean, looking forward, I mean, I look back to what I was predicting last year, and I thought that we'd get a rebound in Chinese stocks, and which we actually ended up doing right at the end. But now I think, and then I remember I was saying some of the other names, like I thought Moneyline's gone down the tube. K-Web is pretty much now where it was back in the 30s again, after going as low as 18, and then as high as I don't know, I can't remember what the high was, like 35, 36. But I mean, this year, I've already mentioned, I do think we're going to get some good rebounds in some of these absolutely demolished names. But in terms of trading strategy, doing it, I think last year, I have actually like small portfolios that does every type of strategy, such as like a stock fund where I'm just basically going long stock. Then ones where I'm a bit more aggressive on the options, and then the portfolio that I share, which is the Money Discourse Trade Log, that one where it's a defined risk. And in fact, the defined risk portfolio ended up being the best strategy for this year, purely because it was defined risk. And I think that type of strategy will in fact probably be the best strategy again next year. Because if we actually look at last year, I can't remember the exact amount, but I think there were over 2.5 times more S&P and NASDAQ days where we moved more than 1% either way than there was in, let's just say, 2021. I mean, the volatility this year and some of the moves we've had have been so big that it's quite hard to just, unless you've got a big account, to sort of survive some of these swings and some of these stocks and some of the things that have moved. I mean, Netflix earlier on the year that went down all the way to like 160, and now it's 310. I remember this Adobe move when they made the acquisition of that company for 20 billion, FedEx, Target, like some of these moves on some of these massive stocks, and Tesla again, it has just been huge, where you think these are, Amazon, for example, literally down 50%. But I mean, if I summarize this year, earlier we were down, but we ended the year realized gain of just under $1,600, which is about 17% return on this size portfolio. Still have open positions, but they'll be carried over to 2023, which with varying successes, like K-Web's looking good, Google's looking all right, USO, but some of them are not looking that great. But I bring this up because anyone who wants to track it, again, it's just for entertainment purposes only, just what I'm doing. It's not a recommendation to buy or sell or do anything, but I'll be now updating when I put on the trade on the new Money Discourse Twitter page, which has just started up. So the thing is that as soon as I put on the trade, I'll just I'll put it on the Twitter page, just to let you know that I'm doing it and I'm not cheating and I'm not doing I'm retroactively putting these trades on just to show that it made it look like I made money or not. Like, I don't care. Like this is strategy. When you lose, it is what it is. So the latest trade I did, I was taking advantage of future fintech. Is that what TIGR is? It's along with Futu. They had some Chinese regulator saying that they're doing some illegal activity. So they were down like 30% a piece. So I just took a speculative credit spread on them. And so you can see what I did the trade here, and then the link to the discourse page, which then shows the actual trade that I put on, which is this one over here. So on this particular one, I did the 2.5, 3.5 put spread, took in $42 credit for $58 risk on a one lot. On this particular one, done 3 contracts for this portfolio size. It's $174 risk for $124 potential profit. So yeah, this is 126. So this is so if you guys want to subscribe to this page, feel free. I'll also be putting out a lot of my thoughts or just latest news that that I see during the day. I'll just tweet out on here as well. So if you want to just stay up to date with some of the stuff that I'm looking at or that we're both looking at, you'll see it all over here. So feel free to subscribe if you would like onto this page.
Yeah, I'll just give a few things that I think might happen in 2023. I think that the Fed will probably have to U-turn, or they'll have to pivot and U-turn in the second half of 23. I think we're going to have a rough economy up until then. I think that oil might, go sub 60. WTI going sub $60 next year, and I think potentially Elon is still going to be doing stuff at Twitter, and he's still going to be distracted. I think he won't be able to take his attention away from it. Yeah, that's what I think.
It's a dopamine hit on Twitter. It's just the real-time interaction, the real-time thing, the real-time you see the amount of people that are, just engaging, and I guess it's just much more fun on a deep down level than it is just engineering. I don't know. It seems that way on the surface. Like, again, you don't know, but it seems that way on the surface.
Yeah. So, I mean, if I had dry powder, which I don't have anymore, but if I did, I'll be waiting for that Fed pivot and U-turn to start deploying, at least significant amounts, because up until then, it's pretty much a bit of a lotto. But like you said, Rajan, there are certain stocks that have been battered so much that, the market will try to preempt. They're already pricing in like a terminal rate that's less than what the Fed say it's going to go to. So the market's discounting again, but we never know because, but the good thing is that the lagging rental data will start coming in, showing rent declines, and hopefully the Fed aren't hacked. So they, are going to be try to, keep the American economy going. Because I don't see how, there must be lobbying groups that are part of the housing markets and all of that. Are you have to start doing something, because obviously we're going to be having huge falls of house prices next year as well. It's going to really hit investor sentiment as well. So we'll see how that goes. And yeah, I think that CPI will fall to sub 4% next year. So those are my kind of predictions. What about you? Well, I guess you've already.
I think it's a similar thing. There was this one tweet I was looking at in the housing market, is that we still have many registered realtors. In fact, it's still at a high despite what's happening. And I guess, and this is according, a lot of them are part-time, obviously, but it's, you would have thought that once the amount of realtors out there, they start declining from this record high. It's like 1.6 million. I forgot what the exact number is, but when you start seeing these signs that it might show a bit of a bottom. But the thing is that a lot of these home prices, when you see the existing sales and the new home sales, a lot of the problems, a lot of what's happening in the housing market is very regional. So in fact, the Northeast is still strong. I mean, New York or the New York area, this whole Northeast region, it's not really suffered that much. But I mean, if you go to the West Coast, like Seattle, and then some of these other hotspot areas in the past, there where you've seen a lot of the declines in price, the price and activity. So it's really a tale of where everything is happening, and there's like a lot of housing issues in certain parts, but not so much in other parts. And so I think, to be honest, we're just going to carry on as we were at the end of last year. I think for the first few months, I'm not going to really, I'm really dialing back any purchases or anything until we start seeing a clear pivot in any type of central bank move, because that is basically what rules the market. As we've said many times, follow the Fed, and that's your path. We had actually David Tepper, I think I mentioned it last time, from Appaloosa. who's a very successful hedge fund manager, and is great at reading the Fed. And he, on his last CNBC interview, he did note that he will be leaning bearish by what he reads of the Fed. So, I mean, I think for them right now, clearly they've said many times inflation is their number one target. So that's what we have to all just look out for. As soon as we see the language change, I think we could start seeing some, especially some of these tech names, start to rally.
Yeah, let's see. But one of the tech names that I'm very concerned about is Google. I still own shares in Google, but I offloaded half my position because I'm seeing how ChatGPT and these AI chatbots, which I'm sure you've seen news articles on, and I've been actually using them, and I find them so fascinating. And unless Google comes out with their own version of a ChatGPT like model, it seems like the relevance of Google is just going to keep going down and down. I know they are working on certain things. I mean, I know a couple of years ago you'd have a chatbot can call up a restaurant and make a reservation for you, but that hasn't come to general. The regular consumer can't actually use that. So it'll be really interesting to see how Google tries to keep their dominance, because Microsoft Azure actually powers OpenAI's ChatGPT and GPT-3 models, and all it will take is for Microsoft to just put some of these online under the Bing brand name, and you just create a site where you can ask it any questions, and instead of you having to click onto another site to get the answer, it actually just gives you the answers, and you can converse with it, and literally it's kind of like a real assistant for you, and can write code and do all sorts of things for you, write essays and write your emails for you with just some prompt. It's such a big threat to Google. Some people are saying that Google is going to drop 20% again next year, but obviously it's still a cash printing machine, Google is, and it will continue to be that in that space for advertising. But how it's going to put up a fight to these GPT models will be really interesting to see.
We'll see. We'll come back. We'll see how this all pans out. But so happy New Year, everyone. Let's hope 2023 will be a good year. I think that 2022 has now prepped us in a way where we've sort of got away from this madness that we had in 2020 and 2021, and so our expectations have been tempered and realigned, which I think will actually help a lot this year in terms of trading activity, our risk profile, and just in general how we approach this market. So I think it shouldn't be as bad as it was last year, especially initially. That's what I'm hoping. So let's see how it all works out. But if you liked and heard what you heard today, please give us a like and subscribe, and looking forward to doing a lot more of these this year.
Happy New Year, and we'll see you guys in the next one.